All right, we are gonna go ahead and get started. We are gonna record this, so I know there's a few more people that had registered, but I also don't want to take advantage of your guys' time, so they can always go back and listen to the parts that they missed. So thank you for joining us. We are going to go through the new lease standard. We'll go through just the slides and kind of explain the standard and then answer any questions that you guys might have. So to start off, I'm Sheridan Jurgensen. I'm one of the partners here. I oversee the nonprofit department division of Eater Casella. And then Michelle as well is here. She is our nonprofit audit manager. So we're kind of going to be splitting this up so you don't have to listen to one of us for the whole time. And then, as I said, afterwards, we're going to send up a follow up email that has the slides, the spreadsheet that we're going to be talking about at the end that we're going to need you guys to fill out, as well as the recording. So don't feel like you have to make a ton of notes. We will give you all the slides and the spreadsheet as well. So to start off then, the new lease standard, the first year that it is going, the year ends that it's going to apply to is December 31st of 21. So all of the audits for December 31 coming up are going to be really the first clients that are going to be implementing this new standard. And then moving forward, everyone else after that will then implement. So we wanted to get this out for sure for the ones that are December 31st, just so you have time to start working on this, as well as then it's helpful for everyone afterwards, just to give you some time to start looking at these leases, looking at the agreements, pulling what we're going to need so that you're ready for the audit. So just kind of to back up as far as in the past, how leases have been treated, basically FASB has kind of divided them into two categories. There was operating and capital. And to an extent, it's somewhat similar with the new standard, but as standards tend to be, it just tends to get a little bit more complicated and the disclosures and what we have to put in the audit report, uh, that amount of disclosure increases as well. So we will go through kind of the differences and then what you're going to be seeing as far as how this is going to work for you. The other thing that I wanted to make sure that you're aware too is that when we are looking at implementing this, we are going to be looking at the first day of your fiscal year. So I will take the December 31st, 21 year end as an example. We are going to 22 year end, sorry. I'm a year behind. Um, we are going to be looking at leases that existed as of January 1st of 22. So whatever the first day of your fiscal year is, that is what we're going to be looking at. So it's really important as you're looking at them, if during fiscal 22 there was some leases that expired or ended, we still have to consider them if they were in existence on January 1st of 22, as well as then anything that was signed and put into place during the current fiscal year. So just wanted to point that out so that you're kind of aware of what time frame we're looking at and what we're going to need when we look at those. And then before we get into it, I also just wanted to mention that there is a section of the lease standard that's related to lessors. So people or organizations that are leasing out to other organizations, individuals, et cetera. And we are not going to go through that today. There, just from what we know of our client base, we only have a few nonprofits that that's really going to apply to. So I didn't want to add a whole nother section on this when it's not going to apply to the majority of you guys. And the few that it does, we'll absolutely sit down with you and we will go through that separately. So I just wanted to make this um, as uh, detailed as possible, but not giving you too much to overwhelm you. So the goals or the objectives of this webinar is just, again, to understand the new standard, understand the impact of the financial statements and the audit report, or the impact it will have on those. And then also, more importantly for you guys, what we are going to need from you for the audit. So we will get started. So the first slide is just the definition of what a lease is considered under the new standard. So, according to the standard, it is a contract or a part of a contract that conveys the right to control the use of identified property, plant, or equipment for a period of time in exchange for consideration. And so the main differences between this definition and what was considered a lease prior to this is the contract, part of a contract that wasn't part of it. It also adds in the control aspect and exchange for consideration. Those are all the three main differences between um, what was previous and what is now with this new standard. And so we're going to go through kind of each part of that. But obviously, as we're looking at a lease, there needs to be a contract. There needs to be something in writing. I don't think that is going to happen too often where you're going to have verbal agreements, but it does need to be something in writing. It also needs to be an identified asset. So in the lease agreement, it needs to specify what that asset is. Again, I think that's pretty obvious, but that's in there. And then the exchange for consideration is also important. So basically, there needs to be some exchange of money. If they are giving you a piece of equipment that they're leasing to you, then in order for it to be a lease, then you need to be paying them for that. The one thing that I will point out is that it really should be reasonable consideration. And so, for that to be the case, if you have a lease that you are leasing a building, let's say from the city where you are located, and they lease the building to you for 100 years for $1, that is not going to be considered um, reasonable, because obviously that is way, way under what you would typically have to pay to lease that type of building. And so that will not fall under the lease standard. So if you have any of those dollar agreements, we will definitely look at them, but they probably will not fall under this. So. And then just a couple definitions. So the lessor is the vendor that is leasing you the item, the building, whatever it is. And then you, as the nonprofit, assuming that you're getting these items, you are the lessee. So just wanted to make sure you understood the difference between those two. So then this next slide kind of gives you a flow chart, and really this is geared to kind of break down what control means. So going back to the definition on the previous slide, it said that the lease needs to for it to be a lease, you need to have the right to control the use of the asset. And so what control means, I mean, it could be anything. And so this kind of gives you a flow chart of the things you need to look at to determine if you truly have control of that asset, which would then result in this lease. So the first couple items are really the main parts. Obviously, we already talked about the identified asset. If that is listed, then you're going to say yes and you'll continue down. The next one is the right to economic benefit of asset. So basically, this is just that you are being able to use the asset and whatever it's providing is you're able to use. So if you have a copier, when you print copies, you are able to use those copies. So if that is yes, then you continue on. And then the next one is the able to direct the use. I think normally for what we've seen with leases, this is going to be yes for most people. This is basically just saying that let's say you have a copier, you're able to determine where in your building you want to keep that copier. You're able to determine when you want to use it, how you want to use it, how often you want to use it. And so all those would say that yes, you have the ability to direct the use of that asset. And if that's the case, then it is a lease, and we will then have to apply the standard to that lease. Occasionally, and I don't think this is really going to happen with nonprofits, it's more businesses. If for some reason they didn't necessarily have the ability to direct the use, then we would continue on down the flow chart and determine if they had the right to operate the asset, as well as if maybe it was an asset that was specifically designed for them. So again, I really think that you will end up going through the first three, saying yes, or maybe no on the previous two, but I don't think you'll go any further than the direct, the use of the asset. So assuming all those, you then would have a lease. And then we will then go to just a couple things that would not be included, and Michelle will go through these.
Mhm. So when you have that lease, you can look and see it does not include items that are for intangible assets. So if you have goodwills or if you have patents or trademarks, that is not going to be included in this standard. Also, the use of minerals, oils, gas, any biological assets such as lumber, your inventory, and then assets under construction. So if you are building something or you're kind of working with somebody to have something built, that is not going to be included within the definition of what these leases are for. I'm going to go to the next. It also does not include service contracts. So your sometimes contracts that include maintenance or staffing, that those parts are not going to be included. And then it doesn't include your short-term leases. And they describe short-term leases as leases that are 12 months or less, including any extensions that you have on those leases. And then does not include an option to purchase the asset that a leasee is reasonably certain to exercise. So that is kind of the main key point of what it is. If you have that purchase option and you are not going to exercise it, then we have to look and see like, okay, is that really could be considered a short-term lease? And then when we say reasonably certain that we are going to extend it or not extend it, we're kind of looking at that 75% sure. So some of the things that you can consider when you are trying to say, hey, when you sign this lease, are we going to buy it at the end of the lease or extend the lease terms past that time frame? The market conditions comparable to the terms and payment. So if they're telling you that at the end of it, you can buy it for a large dollar amount, you're not going to go ahead and say yes, because the market is going to say you can purchase that at a lower value at the end of the lease and just, expire that lease. The cost of terminating the lease and starting a new one is also a consideration. And then the importance of the lease to the organization's operations. So if you need it to continue, if it's part of the building that you're currently in and you know that you're going to stay there and not want to move, that's going to make it a little bit more reasonable and certain that you would extend that option. And then the short-term lease with the 12 months or less, the standard does not apply if elected by the organization through an accounting policy. So there are two different times within this lease standard that there's going to be a new policy that we suggest that is implemented by the organizations. And so this policy states that this lease standard is not going to apply for leases that are less than 12 months of all asset classes. So they want you to kind of put this policy in place, even though it's exactly what the standard says. They want you guys to be able to have that, bring it to the board and kind of implement that so that going forward, you don't have any confusion of what is or is not a short-term lease.
All right. Now we'll go into the two types of leases. So we're going under the assumption we just went through the flow chart and we do whatever agreement it is that we do have a lease. So now we have to determine what type of lease. So this is where it's going to be kind of similar to what we saw previous to this standard, where you have an operating and a finance or capital type lease. Um, Little difference, but you'll see some of this is somewhat similar. So for the first one, the first type is a finance lease purchase. And in order for it to be that finance lease, one of these needs to apply. It doesn't need to be all four of them. It doesn't even need to be three. As long as one of these is occurring, you can consider it a finance purchase. So the first one is if the lease transfers the asset at the end of the term, then it's a finance purchase. So if in the agreement it says that that copier, when you are done with the lease, it automatically, the ownership reverts to you, then it would fall under this type of lease. If it contains a purchase option that you as an organization feel is reasonably certain that you are going to exercise, then it's going to be a finance purchase. So again, going back to that reasonably certain, like Michelle said, we're really looking at, you're sure that you are going to go ahead and exercise that. Obviously, things will change, but we are looking at this time when we're coming out for the audit, what you feel at this point. And we'll get into it in a few minutes, but we do have to look at reassessing them potentially if those things change in the future. But this is at this point in time what you as an organization are thinking you will do. Then the third one is that the lease term is for the major part of the economic life. So the economic life is really the useful life. So if we're talking about, well, I keep going back to a copier, but we say the useful life, a copier typically will last, let's just say 5 years. So if that lease is at least 75% of that life, then we would say that you meet this criteria. There was something in the standard, kind of a caveat that if you have a lease where either you're getting an old asset or just based on the timing of the asset, when we go ahead and implement the standard, it's already in the last 25% of its life, then this does not apply. And then the last one is the present value of the lease payments and the residual value equal or exceed the fair value of the asset. And so the standard kind of says that 90% is a good number to use for that. So going back to the copier, if we say the fair value of that asset, let's just say it's a $5,000 copier. If the present value of your lease payments are 90% of that $5,000 or more, then we would say that this meets that criteria. So again, if it meets any one of these, then it will be considered a finance purchase and we're done with that part. If you go through these and none of these apply, then by default, it's going to be considered an operating lease. And so you'll fall into this second category of a lease. We'll get into it in a second and you'll see the way they get treated on the financial statements is somewhat similar. The disclosures are somewhat similar, but there is a few differences as far as the actual journal entries and accounting for these two leases. But we will get into that. And then also I had mentioned before, just the reassessment during the lease term. So if there's something that changes after we implement the standard and something changes in future years, then we need to go back and reassess it. So let's just assume pre-COVID, you leased a building for 10 years in January before COVID. Suddenly COVID hit and you realized, well, now I don't need this building. Everyone's working remote. I don't need this much space. There's not going to be that many people coming to the office anymore. And while your intention was to keep it the full 10 years, things have changed. And so during that year, if the standard was already in place, we would look to reconsider, okay, well, what are your plans now? Do you plan to end the lease early? Do you think that you're going to just not take the option to extend that you had originally? So those are all things that we're going to look at. And based on that decision, then we may have to revalue the asset, the lease asset and liability. So that's just something that we're going to be looking at each year and just going through those leases to determine if they need to be reassessed.
And so then when we're looking at these lease payments, We need to also determine what is included in the lease payments, because those are going to factor into our present value and everything that has to go into how we're recording these leases now. So with the lease payment, we are going to look to see what your fixed payments are, less any incentives that they might be giving you. If you have a variable payment based on the index rate, and then how does that index rate change? Any penalties for terminating early. And then that is only going to be considered if it's reasonably certain that you are going to terminate early. So there's kind of twofold right there. And then your exercise option to purchase if you're reasonably certain that you are going to exercise that option to purchase. So all of those are considered in that lease payment. But then if your lease payment includes things like property tax and insurance, those are not going to be in this calculation. Then the amounts allocated to non-lease components, which I'll get into what that is in a second. Lease payments based on a percent of sales. So we're not going to include those since it could be ever changing and we wouldn't really know what the value would be. And then increases in the index or rate since the commencement date. So those are types of things that when we're reading through the contract that we'll have to list out because those are not going to be included. And so then back to that non-lease components, these should be separated out from the lease components. And so, for example, if the lease has a server, so you talk with your IT company and you are leasing a server from them, and there is a portion of the lease that's related to the maintenance and the updating of the server, where those would be the factors that the non-lease components that we would be kind of debating on whether or not we were going to separate out from the lease. But here's that second accounting policy that I was talking about. And you guys can create an accounting policy to elect to not separate out the non-lease and lease components for all asset classes. And this is good because a lot of times those contracts might not tell you what the difference is between, how much of that payment goes towards the actual object and the maintenance part. So if we adopt this accounting policy, then we don't have to go into that detail of trying to figure out what portion of that payment goes to maintenance and the actual item. And then when we're looking at the terms, which is also factored into this whole calculation that we'll be going through in the next couple of slides, we need to say, okay, what are the lease terms? Are there any non-cancelable periods? Do you have any extension options? Are you going to extend it? Can the lease be terminated by the lessor? Can they come in and say like, hey, you're done with this object now? And then the exercise option to purchase if it's reasonably certain. So those are some key points that we'll look at and try to pull out of these contracts while we're reading them.
Okay, so now we're going to go through really the important part on how this is going to affect your financial statements. So whether it's a finance lease or an operating lease, it is going to change your balance sheet or your statement of net position, because we now need to show a lease asset and a lease liability for those leases. So for the lease liability, we are going to take, as Michelle mentioned, the payments. So we're going to take your total payments and get the present value of those. That's a calculation that we will do. So that's nothing that you guys need to worry about. And that present value is going to be done using a discount rate. So ideally, the lease agreement has a rate listed in it, and it's telling you kind of what that interest rate is that's part of those payments. If that is not, because not all leases have that, then what we would be looking at is for your incremental borrowing rate. So really that's the rate that you as an organization would be able to obtain if you went out separately and got a loan from a bank to purchase whatever item it is, or at least whatever item it is. So that's what we would look at. And we can work with you on that. Sometimes just calling the representative at the bank, they can kind of give you an idea of what that rate would be, um, just so that we have some clue. And it's also important, depending on what asset it is. Obviously, an interest rate to, let's say you're leasing some vehicles. Probably that interest rate is going to be a little different than if you're leasing a building. And so the mortgage rates are obviously going to be different than a car type purchase. And so that's another thing that we'll kind of look at is making sure that it's a rate that is reasonable for the asset that you are leasing as well as for the time period, because a 2-year lease is going to be very different than a 20-year lease. Um, and then it talks also about a risk-free rate. So, I mean, really, I think normally we can just look at one of the first two. Either it's going to be in the lease, that's easy, we can just use that, or we'll look at what the organization has as far as a possible borrowing rate. The other thing that it does mention in the standard that is if the rate on the lease is a very high rate for whatever reason, let's just say it's a rate of 15%, but you know as an organization you could go out and have a rate from just a bank of 5%, then we would use your incremental borrowing rate since that's the lower of the two, because we don't want to inflate that present value too much by using a really high discount rate. So that's the liability side. So at the end of doing this calculation, we'll have the present value of your lease payments. So we'll record that liability. The other side of that will be your lease asset. It's going to be the same amount as your liability, but it is going to be adjusted for a few things. If you made any down payments or you made payments prior to the lease actually starting, that's going to be included and added into the lease. If there's any incentives, that will be taken off the asset. And then any other direct costs that you had to have to get this lease set up. That is going to get added to the asset as well. So then after that initial recording of the leases, for each year, then after that, as you pay down on this lease, as you make the lease payment, the total cash payment is going to go against the liability. And the lease liability is also then going to be increased by your interest expense. I know that sounds a little confusing, and why would you add the interest back in? Ultimately, if you're netting the total cash payment with your interest, essentially you're reducing the liability by the principal amount. So um, it's a little bit more of a confusing way to basically just say you're reducing it by the principal amount. And then on the asset side, you're going to be reducing it by the amortization of the asset. So similar to what you would do for your fixed assets, you depreciate it over the useful life. Um, this is going to be the same thing. So this slide, though, is specific to finance leases, and this is where it's a little different between the two leases. So for the leased asset, we're actually amortizing it over the economic life of the asset, not the lease term. Because with the finance lease, basically there's something in that agreement that's happening that you're ultimately going to be keeping this item at the end of the lease. So it is then going to be amortized over the life of the item. So let's just say copier, we say it's a 5-year useful life, but you are only leasing it for 2 years, but you are going to keep it afterwards. So we're going to be amortizing it over 5 years, not the 2 years that the lease term is. And then for the operating, you'll see for the lease liability, it's the same thing. We're reducing it by the cash payment and then increasing it for the interest expense. For the lease asset, though, this is where it's different because you're not basically planning on keeping this asset. So we're just amortizing it over the lease term. So with that copier, you're just going to amortize it over the 2 years, and we aren't concerned with what the useful life is of that asset. And then also for the operating lease, there's two components of the expense. We have um, the amortization expense, as well as the interest expense. And so that actually, for an operating lease, is just combined into one lease expense. Whereas for the finance, they have to be separated out. So ultimately, the operating lease is a little bit easier, although not too much, unfortunately. All right, so I did want to give you an example because it's obviously a little easier conceptually to understand it when we're actually using a real life example. So we're leasing equipment in this one. This is a finance lease. We're leasing it over 4 years, and the payments there are listed. They're variable payments for whatever reason. That's how the lease was set up. So you'll see the total of lease payments comes to 456,500. When we take the present value of those payments, um, and I didn't put in here the rate, but we just got to a flat 400,000 to make things easy. And there's a 10-year economic life or useful life for this equipment. So when we initially record this, we're going to record the right to use or the lease asset and the lease liability for that 400,000. So that's the journal entry that we're going to make for that first year or when we implement the standard. And then for the first year, you'll see up above the payment was 100,000. So when that cash is paid out, obviously you would credit cash and you will debit the lease liability for that $100,000. Then for subsequent years, we'll just look at the first year. So I put the table up on top just so you could kind of have those numbers. But the lease expense is $22,080. So we are going to record the lease expense and then increase the liability for the 22,000. And then there's the amortization. So going back again, since this is a finance lease, we are going to amortize that $400,000 over the 10 years. So that's $40,000 a year. And so that will be, you'll reduce the asset by the 40,000 and then the amortization expense will be 40,000. All right, and then same example, but we're saying that it's an operating lease. So this first slide, everything is going to be exactly the same. We're recording the 400,000. The cash that's getting paid is going to go against cash and against the liability. What's different though is then when we get to the subsequent years, you are going to record, so make sure I have that. You're going to record the lease expense, which is the $114,000, which is essentially your total payments divided by 4, since it's a 4-year lease. You're going to reduce your liability or increase your liability by the interest, like we did on the other one, which is the $22,080. And then you're going to reduce your asset by the amortization. And that's the amortization for the 4 years. Because again, it's operating, so we're just doing it over the term lease, the term of the lease. So I wanted to at least give you kind of what the journal entries are going to look like. I know this is really confusing. It's actually, I mean, there's just so much to it and so many exceptions and various things. And so we absolutely will be working through these and recording them for you this first year. Unless you are totally confident you want to do this yourself, that is absolutely fine with us. But we understand that this can be confusing and something that most organizations haven't really recorded on their financial statements ever. And so just, we can work through how these are going to get recorded. And then going forward, once it's set up, obviously, then it's easier to kind of give you the journal entries then that need to be made every year for those.
Okay, so now that we kind of know what the journal entries look like, we'll see how that applies to the actual financial statements. So on the statement of net position, we have to present it separately and then also have it out on the notes. And then you cannot combine the operating leases and the financing leases. So if you do have both types, there will be multiple lines that get added to the financial statements. And then we do need to separate out current portion. So you'll see some of it down under the long-term asset. And on the next slide, I have the details of that. So you can see the right of use assets under the long-term assets. So kind of right underneath your property and equipment. That would be the total of for the right of use. And then the liability portions, you will see that you have the financing long-term, the operating long-term, and then your regular long-term debt that can all be combined into one. And then you do have to show the current portions for each of those ones out separately as well. And then with the footnote sample, it's very long. I don't want, you guys can go ahead and read it. This was an example from a business. So it's got a little, but the main key points that need to be in here is what is the lease for? So it's going to tell you exactly what you leased, but this particular one was a facility and what they used it for. And then how it's classified. Is it a finance lease? Is it an operating lease? And, the lease terms. So the full terms of the lease, that it was 30 years and expired in here, that it's 10 years and expired, that we're going to keep it over the life of those 10 years. Any options that you have in the lease. So whether or not at the end of the lease, you can purchase it and what the value would be, or if you can renew it. And if you're renewing it, what the value you'd be renewing it for and how long you'd be renewing it. And then lastly, that last line is the accounting policies. So which is a good thing that you have for adopting those accounting policies, because in the footnotes, we actually have to list them out, saying that you made an election not to recognize right of use assets and lease assets that arise from short-term leases. So that's why it's a good idea to get those applied before the end of the year so that we can add it to the footnote. And we have everything that the standard is requiring. In the footnote sample as well, we'll have the details of those leases and kind of like you would normally see in your long-term debt lease long-term debt footnote that explains what your lease costs are. And then we can use this to tie back to what the front statements say. And then as in with your operating leases and capital leases from before, we have those maturity dates. So we'll list it out for 5 years and then anything thereafter, adding back with some of the present value and your current lease, current liabilities under the leases, because we want these footnotes to tie back or tie up to the front financial statements. And so what type of things that you guys should be doing now is looking at all of your past capital leases and operating leases and kind of seeing what you have, knowing that, copiers and those type of things all need to be considered. Talk with your IT department to see what type of items they might know, because they might have entered into an agreement that you don't even know about, and that you might need to take into consideration because those contracts might include the servers, like in a previous example. Look at any of your reoccurring payments. And one of the things that we have to do as an auditing firm is do a search for unrecorded leases. Very similar to our search for unrecorded liabilities that we might do for accounts payable, to make sure that you've included everything in accounts payable. we need to look for those unrecorded leases. So those reoccurring payments that you have every month to somebody, looking to see like, oh, is that really actually a lease? So one of the things we're going to be requesting that'll be new this year is a check register for the whole year so that we can put it into some data analytics software and kind of see what we come up with if we find anything that looks reoccurring, and we'll bring it to you or make sure that it coincides with what you have filled out on the spreadsheet. And then what you should be also doing is gathering all of those lease contracts starting from the first day of the beginning of your year, and gathering all of that information so that when we get out there or get close to year end, start the planning for the audit, we can kind of look at the spreadsheet that we have created that Sheridan will go over next, and get that all filled out so that we have everything kind of ready for when we get started for the audit.
All right. So now we're going to go through the spreadsheet. This is going to be what we are going to be asking you guys to complete based on everything that you found just from the different steps that Michelle just went through. This will be sent out after the webinar, if not today, for sure tomorrow, so that you have this, as well as we will provide it when we are providing you with the list of the items that we need for the audit if for some reason you don't have it or lost it. And also, before I continue on this, if you guys do have any questions so far, if you just want to put those into the chat, there's enough people. I don't want to, you know, um, unmute everyone, but if you can at least put it in the chat, and we can go through those once we're done. If you do have something that's really specific to your organization, then we may just contact you directly, just so it may just be easier that way. So we will go through this spreadsheet then. So the first part of it is just really the information from the agreement. So you're listing out the vendor, what the item is, the lease terms, when it starts and ends, frequency of the payments, as well as the borrowing rate if it is in the lease agreement. So that should all be fairly straightforward to get from the finance or from the lease agreement. So if you can fill all that information out, that would be great. And then this next part is where, we're going to start applying some of the things that we went through, that we determine whether this agreement that you have is truly a lease. And so we are asking that you take a stab at answering these 4 questions. Um, Obviously, there is some, discussion that may need to occur to determine whether those truly are the correct answers or not. And so we're not going to hold it against you if, it's wrong or whatever, but we wanted you at least to take a stab at it. The first one, if it's 12 months or more, then, it's not going to fall into that short-term category. So you would answer yes. If the contract is written or verbal and is legally binding. Again, I don't know that anyone has verbal, so we'll just hopefully it just doesn't apply. You can mark that, yes. And then the right to determine the nature and manner of use of the underlying asset. So that's kind of where we went through that flow chart. Basically, if you have an asset that you have on your property and you really have the say on how that's getting used, and where it's getting used, then it more than likely is going to be yes. If you have any question on that, though, obviously Michelle and I are always available, and we can go through that more in detail with you. And then the right to operate the asset, same kind of thing, just making sure that that the organization has that ability, and that is part of the agreement that you have that right to use it. If all those are yes, then we're going to say it's a lease agreement. And then from there, then we're going to look at which kind of lease it is. Um, we just wanted at least to get this part started, and for you to fill out this part. Obviously, then we need to look at the 4 criteria to determine what type of lease it is. But we can go ahead and help you with that. If you want to take a stab at that, that's absolutely fine. And you can just add to this spreadsheet. or we can provide you with something else where you can document that. But we at least wanted to get this part on here, and then we can go through the rest if needed and determine journal entries, etc.
The one question that we do have is there an amount limit? They have a postage meter, which comes around at $395 a year.
So that's the one thing, is that materiality will absolutely come into play. So I think probably for every single one of our nonprofit organizations, a machine is probably not going to be material. But what we'd be looking at is your total payments on that lease. So at $300, if it's a 2-year lease, you're still not talking a ton of money. I would still, though, put it on this schedule
Mhm.
because it is the kind of thing we do need to look. I mean, if you had, let's say, one lease for a postage machine ends up not being material, but for some reason you actually lease 20 postage machines and they're all separate leases, then we kind of need to look at it in total and say, okay, well, now this is getting to be material. So listed, but more than likely that will not be included. Um, as far as materiality, it's going to be different for every single organization. So that is something that once we come out for the audit, we can start looking at. If you have questions about that, just let us know, and we can kind of at least give you some guideline. But again, if you have quite a few leases, even if everyone is not material, we kind of do need to look at them in total. So there may be instances that even though it's not material, that it will need to be recorded. And then on the just the last part of this spreadsheet is just listing the journal entry, or I'm sorry, the general ledger account where you typically make those payments, just so that we kind of know where to look as we're testing that and determining the journal entries for that. So that is kind of a quick summary on the standard. Again, as I mentioned before, there are a lot of exceptions and a lot of different things that come into play here, but I wanted to keep it as basic as possible. And then as we get out, if people have more complicated things and agreements that are a little bit more confusing, we can work through those individually with you. Also, as I mentioned, if you are a lessor, so you're leasing part of your building, you're leasing something else to another organization or individual, we will work with you on that. It ends up being somewhat similar to how we do the leases, except that it's a receivable. So it's going to show up as an asset for the money that you are going to be expecting to receive for that asset. The other thing that we did want to mention is that with this new standard, as you can see, the amount of work involved is quite a bit. What we are going to do, we didn't want to just give everyone a flat fee that included the whole standard, because it really depends. There may be some organizations that they don't have any leases, and then others that may have hundreds. And so obviously there's a difference in the amount of time for that. So at this point, our flat fee just for doing the test to see if there are leases and looking at everything is going to be $750. And then after that, if we determine that there are leases and we have to go through and do journal entries, etc., then that fee will increase from there. And that will be something that we will talk to you at that point just to determine what that is. I mean, it does not get too crazy. I think the other organizations that ended up having them, it ended up being another 750, 1,000 at most. But again, if you do have a lot of leases, then that could absolutely vary on that. The other thing that's really important is that those fees are really assuming that you've done what you can to fill out that spreadsheet. If we come out for the audit and the spreadsheet isn't filled out, um, and you really need our help, that's absolutely fine. But that will be kind of additional to that 750 as we look at those agreements and we fill it out. And again, it doesn't have to be everything. If there's certain things that you're just not sure of, put notes on the spreadsheet and we can absolutely work through those. But as you can see, just if you do have a lease, the amount of information now that we need in the footnotes and disclosures is just, it's quite a bit. And so it's going to take some time to get that. And then we'll also, if you get to the point that you feel comfortable with how the journal entries are working, et cetera, we can look at reducing the fee in future years if the organization is going to kind of take care of recording all of that going forward. So, any other questions, Michelle?
Not in the chat, no.
Okay. All right. Well, we will be sending a follow-up, as I said, and then I'm sure you will have questions as you start looking at your leases and going through the spreadsheet. We are absolutely here, so please just reach out to one of us and we can work through those, and we will go from there. So thank you for your time, and yeah, enjoy the rest of your day.
Yeah.
Thank you.
Thank you.